Hello everyone, welcome to the WD Gann Master Commodities Course, and we are trying to identify certain hidden rules which are there given in WD Gann's book, which is the Master Commodity Course. We just have to probably find out where exactly it has been written and how to interpret for that. Can we identify the structure? First of all, can we identify the structure and probably from the range or maybe from the second top, because he's talking about a selling level. Now, why has he given us a hint about a selling level? Can we identify? Probably we need to work out on that part. That's why it has been said as a hidden rule, where he has given some kind of information, but we have to find out what exactly that is. So let's try to find out a structure of the market. Now, for that, what we'll do is we'll go across the Macon swings, which are starting from 1925 to 1954, approximately a year of 29 years, which has been considered over. This is available on page number 33 of WD Gann Master Commodity Course initially, and this can be seen on PDF. For the PDFs, this is page number 36. And probably if we try to check across with the book where the theoretical details have been given, that comes for Macon, and this comes on page number 21. And for PDF, it is page number 24. So let's try to go across through that. As I told you previously, we on page number 33 have Macon swings. And on page number 20, we have Macon. The details are there. So what we'll try to do is we'll try to probably read across some of the details, maybe the initial page, and try to interpret what is more important for us so that we can accordingly correlate with the theory which has been given. This is for soybeans futures, which is there. If you want to look across on charts, definitely we can do that. Let's say, for example, if I see over here is there was a bottom, there was a top, and from this top, the market did come down to somewhere around 50% rule. So whenever there is a 50% level coming, definitely we can buy across. Whenever it crosses the previous tops, so this is a buying level from where we can go up. So probably I try to go on a bigger time frame, which is monthly. From the bottom to the high, we see a reversal, which is again coming down to the 50% level. So 50% is again important, not only for buying, but if you look for selling across, maybe from a high to a bottom, again coming to a 50% level, yes, you can definitely again sell when it starts crossing below that prices. Again, maybe this was the bottom, from the bottom to this top, again it has come down to the 50% level. And definitely we saw this top, again a second top, this is more like a double top, and from there the market has again started coming down. Again looking for bottoms, this was the bottom, second bottom, whenever it takes a support, you can start buying. So buying, selling, again rules have been given. This is more of monthly chart. This is for soybeans futures, which is there. And the initial date that we get across is December 1968, not before that. December 1968, 1970. This is what are the dates which are being getting, especially for futures. Before this, if you are getting any kind of dates which is there, maybe on TradingView or investing.com, please do let us know so that we can probably use that code and then probably try to find out more details. So we come to the theory part, which is Macon. We'll try to see about that and try to see how is the structure of the market. Let's say we start from here. You will find the chart on Macon covering all the main swings from January 1925 up to date, that is 1954-55. Study this chart and apply all the rules just to say just the same as we have applied them in examples of soybeans and wheat. So of course, before this, soybean and wheat has been given, but we wanted to start from Macon. Nothing like it. I mean, like nothing like an interest for Macon or maybe for soybeans. But yes, soybean will come down to that later on because there are much more details which are to be identified with soybeans. You will note this chart from 1925. So if I go over here, these are the dates which have been given. Let me probably zoom it across. So this is from 1925 April, and before this is January 1925. So this has been given 1925. So this is 1925, this is 1925, which has been given. This is January, this is May. Where the price started down from 137. So the price which was there as a high was 137. So look probably at the high. This is 137. How do I know the exact prices? So if we look probably over here, this is starting from 128 to 144. Now, if I look at this grid, probably there are 1, 2, 3, and 4. 4 lines which are there in between. So 128 to 144, if I check across, there is an increase of over by 4. How do we know that? If I maybe probably just have a calculator, add on that. So you have 144 minus 128, it is 16. And if we divide that by 4, divided by 4, we have 4. So every increase over here, 128 to next is by 4, that is 132, plus again 4 is 136. Again adding 4 is 140, and then we have 144. So there are darker lines which are just put in across between, and we know how this is there. So this is somewhere around above 136, 137, which is just been given. It comes to make a high of 137. It made lower tops and lower bottoms until 1926, when there were two bottoms around the same level at 67, 69. So we had a top which was there at 137, and we had bottoms which was there at 67 and 69. Let's try to see this. So this is 137, and if we see below, probably this is somewhere around 90, 92. And this price is 64, first bottom 67, and this came to somewhere around 69. When was the time frame? Let's try to check that. So this is there in May 1926 and April 1927. So we had this first bottom, we had this second bottom. From these bottoms, we probably would be able to know what exactly would be coming. I'll also try to show this on chart because this will be much more easier. We, as it is on this chart, we won't be able to find those figures because this is about $2, which is 237. So $2.37. We are having the latest chart which is available from 1968, and our data is there from 1925 onwards. So probably we need to look something in a different way. So from this high, it made a low. The high was 137, and we had a low which is 67. So let's look at the range. 137 minus 67. We come to a figure which is 70. Fine. So probably we'll try to take this on a different chart also, which would be making things much more easier for us. But let's before that go to the theory. So we had a high which was there on 137, and we had a low which came to 67. So we had a range of 67. Why? This is more like a double bottom. So almost at double bottom you can buy, and from here you can start moving up. This was a buying level. So as double bottom is gear, he specifically mentions about lows. So whenever there is a low created and near to that low, if we have one more low, which was just above that, we can buy. So this is among one of the rules. This was a buying level. From there, the price moved up, and when it crossed the other top at 97, you would buy. Now again, this is a very simple rule. Whenever price crosses old tops, you can buy from there. How it is there? Let's look at the chart also. So we had 97. So probably over here 97 we had this previous top. So this was a bottom 67, 97, 69. So whenever this high has been broken, the market starts moving up. Probably you can again buy. This is as per the rule which has been given for buying. Now this date, let's try to see what is the date. This is August 1927. Let's try to see what is there on August 1927. The high in August 1927 was 122, a selling level. We'll also try to find out why is this selling level. If we are able to find in something in terms of ratios or maybe in terms of proportions, again, the things should be much more simpler for us. But at this stage, August 1927, the value is 122. So if I probably look, August 1927, The price over here is 122. Not exactly been over here, but probably if we try to reduce 4 over here from 128, this comes to 124, and just below 124 we have 122. So we can just verify this doing because at that time computers were not there, so everything has to be done in terms of written charts, which have been hand drawn mostly. So we saw exactly this 137 top. We saw this bottom at 67, 69, and we saw above 97 we have to buy. And here he especially says at 122 we have to sell. Now, why this is a selling level? Probably this is again an important thing to know for us. And this is where we are talking about the hidden rules. This is where we are talking about the hidden rules. So if we find out 122 why this is a selling level, it would be much more easier. We'll come down to this part. After that, the price declined and made a slightly lower bottom in 1928 and rallied till May 1928. So no price has been given, just it is coming down. Following this, there were three bottoms just below 80. If we see, probably 122 was the selling level. Market did go down, made this double bottom over here. From there again it started rising, but from here again it started coming down. So around somewhere around 80, this is the line of 80, and just below that, somewhere we can say 76, 78 levels. Just above that, we had this first bottom, second bottom, third bottom. Again, whenever this kind of pattern has been created, this is again a buying level. So probably again we can buy over here, maybe for a small time frame, but again there was a high. This was the second high above which the prices didn't move. So probably you can start trailing your stop losses at this point. But he specifically mentions about this three bottoms. So this is like a triple bottom, double bottom, triple bottom. WD Gann has been very clearly mentioning to us about that part. Maybe probably that would be coming at a later part, but just double bottoms and triple bottoms are important for us. From here again you can buy, but yes, start trailing your stop losses because this was just above this previous high but didn't cross this high or maybe this high. So you can just immediately start trailing your stop losses at that part. Again from here the market did come down. This was somewhere around in 1930. So 1930, or maybe you can talk about 1929, the market did start coming down. Following this, there were three bottoms just below 80. This occurred in 1928 and 1929, and the tops were up to around 110 and 112. So 110 and 112 is where these tops were generally been created. July 1930 was the last high where you would sell short against the old tops. And when prices broke the lows of 77 and 78, you would sell more. So July 1930, first of all, go to that date. So these dates are given probably on the top. July 1930, I'll move my cursor down. So this was the top of July 1980. And from there, when the prices starts moving below probably this lows which are there, so we had 1, 2, 3 lows, and when it starts below that part, probably you can start again selling. But because this didn't go above the previous high, this was a selling level, and again from here the market started coming down. Right. So this was the first bottom. Again, the prices did rise. Again, there was a new bottom. Again, the prices did rise, and again there was a new bottom. So if you see the structure, this was a low, again a lower low, again a lower low. So this was again a high. This was a lower high, again a lower low. So low, high, lower low, lower high, lower low. So this is more like a downside pattern for us, which we can definitely look across. So July 1930 was the last high where you would sell short against the old tops, and when prices broke the lows of 77 and 78, you would sell more. When prices broke below the lows of 1926, which was 67, you would sell more. So this is where you can sell again. price is going below this, again you can sell more. So this is how you do on with pyramiding. Pyramiding is again a important part. Maybe probably as we start going gradually again ahead of the Master Commodities course, we'll come to know where exactly and how do we have to do pyramiding. But just because here he has talked about adding up, that comes to as pyramiding. So below 67, you can again sell more. The decline continued, making lower bottoms and lower tops. Lower bottoms and lower tops, again, that is a pattern which says that you should be going down further until May 1932, when the lows was 28 cent per bushel. There was a rally to 41. So from 28 again, it went up to 41. And final low was in February 1933, when low was 23 cent per bushel. And then he says, after President Roosevelt took office in March 1933 and the exchanges reopened, the trend on all commodities as well as all stocks turned up. And when prices crossed the tops, as you can see on the chart, you would buy. There was a rapid advance further on together. Now, this happened somewhere around in February 1933. And in March 1933, he resumed office, President Roosevelt, when he was elected for that. So if we see the lows, this was in 1933. Again, from this bottom, the market did go up. So this high was in July 1933. We can say from February, maybe in March, it started gradually moving up. And after this low, again, it made a high, again did come down. Fine. So there was no sudden upside movement directly. It made a structure in the market, which is again very important for us to understand. So what we'll do is, before this is a structure that we are able to see over here. This is a structure that we are able to see over here. Let's try to identify and analyze this structure, what exactly has been happening, so that we can accordingly on the basis of that see if similar kind of structures are happening every now and then. So we had this high, which is 137. We had this low, which was 67. This high was 122, and then we had a low which was 24. Of course, this points, probably because I have gone through the charts again and again, I know about these points. You can see over here, January 1925 was 137. From there, it made a low of 67, 69. And from there, again, it made a top in August 1927 of 122. And from there, it made a low which was there of 24 cents. Can we identify the structure? First of all, can we identify the structure, and probably from the range or maybe from the second top, because he's talking about a selling level. Now, why has he given us a hint about a selling level? Can we identify? Probably we need to work out on that part. That's why it has been said as a hidden rule, where he has given some kind of information, but we have to find out what exactly that is. So let's try to find out a structure of the market. Now, what I've done is over here is probably I've taken a different chart over here just to look for the prices. Probably you can take any chart which is there and try to structure and find out if a similar kind of structure has been formed over there or not. So what we have done is we probably just trying to take a structure over here. What are the prices? Let's try to see, and maybe probably we will be just able to verify those prices. Let's say we had a high, the high was 137. So we had the high which is there of 137. So from 137, the market did come down. Don't look probably at the prices as especially which is there of Wipro, but we are just taking them randomly. Why? Because we have this on our Y axis, the prices which have been coming down. So from this high of 137, the market did come down and it came to 67, 69 levels. The low was 67. So from this high, we had a low which was there of 67. Here probably there was a double bottom which was being formed, and from this double bottom the market again started rising up. So what was the price which the market did rise up to? It was 122. It was up to 122. So we see that yes, the market has mostly been recovered, and it recovered maybe probably from the bottom almost by 75%. It did recover. So if you look at the range from the high to the low and the recovery which was there, the recovery was the bottom, it went up to 75%. Fine. So we had a high, we had a low, we had a reversal which was there coming up to 122. So probably in the hidden rule, he has not mentioned anything in terms of more if details about the price. But yes, probably if we see for the selling levels, what is the selling level come to? We see that the market has pumped up almost by 75%. Almost pumped up by 75%, maybe probably just more than that, we can consider it 80% also. From there, the market has again started dropping down. Where was the drop up to? The drop was first of all initially up to 28 and the final drop was there till 24 cents. So you look over here, probably this is 23.74. So we can consider that almost at 24% the market has been coming up. So looking at the structure of the market, how is the structure of the market? So the structure of the market is generally it is a high, then there is a low, then it creates a reversal, and after that the market starts dropping down. So this is the most important structure of the market that we need to know. How it is there? We have a high, we have a low. So this is generally a range which is been from. From this range, generally we can again identify a high which can be coming up to 50% or maybe up to 25%, and from there again it starts sliding down. It can go up probably if we reverse the structure, and it can go down as it's been given in this example. So from this level of 122 we saw that the market did go down, and if we see in terms of structure, probably over here this is almost somewhere around 70%. Range is 70 that we have already seen. And in terms of price, yes, this is coming to 50%. Now again 50%, why this is 50%? Probably we have seen this in one of the rules which talks about 50%. So yes, in terms of percentage, if you see, that is again coming down to the 50% level. Very important for us to note down. So if prices do fall up to 50%, yes, probably that is the buy level for us. And from here, again, it did pump up. So what levels it did pump up to? This is 67. From 67, it went up to 122. So we'll look at the price also. So this is somewhere around 122. So 122 is the price which is being shown over here. So bottom was somewhere around 64 and high was up to 122, which is being shown over here in terms of maybe red marks. So if we check down, probably the price which has been risen up, that is somewhere around 80, 82%. Right? So there is a fall. The fall was nearer to the 50% level, which is being shown over here as 50% level. Again, it pumped up somewhere around by 80%, and from there again we see a drastic fall down. Let's look at this drastic fall down. So it is from 122 onwards going down to 24. So this is my level of 24. The price is again a fall of 80%. How much is the fall? 80% is the fall which is going down. So probably upside movement is again somewhere around 80, 82%. And the fall which is there again, that is somewhere around again 80%. Now 80% is from this price. This 80% is from this price. The bottom structure which is there, from that it has gone up to around 80%. And the fall which we have seen is from this top point. So the top point, if we consider that, and if we see the fall which is there, that price fall has been around 80%. In terms of points, it is somewhere around 98 points or maybe 100 points. From 122 to 24, it comes somewhere around 98. But if we look in terms of percentage, this is 80%. The top side again is coming to somewhere around 80%, just above that. But yes, considerably we can see that yes, the rise probably from this percentage 80%. Now why this is only 80% coming down on the top, and why the fall is again 80%? You can just think about it. Maybe it may not be really in the same way which is there, but yes, this is what we are getting. And again, talking about the structure, what we get as the structure is generally there is a high. From this high, we get as a low. And from this low, again, we see a upside movement or maybe a reversal, retracement, whatever you talk about. And from that, it starts coming down. So the best point to buy over here is in terms of double bottoms. you can definitely go up. Let it rise above 50%. So because 50% is generally considered as a weakness, if it closes above that, yes, definitely you can go on a higher side. Next point would be coming somewhere around to may see my 80%, and above 80% would be my 100% level. And if it breaks that, goes up, definitely we can buy more as per the Gann rules which are there. But if it maybe probably creates a resistance at 50% or maybe at this 80% level which is being given over here, then probably we can think about again selling. Why it is so? It it has been mentioned over here by Gann himself. In August 1927 was the high in August 1927 was 122, a selling level. Very clearly been given over here. What has been given? This is a selling level. Why it is a selling level? Probably this is a hidden rule which we need to work out. See, Gann always wanted us to work out on various things together. Until unless we work out on those things, we won't be able to find out what exactly are the hidden rules. And if you look at the structure, yes, this is probably how the structure has been built up. There is a high, then there comes a low, then there is a retracement, and after that, the market starts falling down. As simple as that. Fine. So here we saw this from a top of 137. From 137, the market did fall down to 67. From 67, it did rise up to 122, which is being clearly given over here as a selling level. And from this selling level, we can see that the market has gone down to 24. Now again, yes, probably we see maybe for some time, maybe it was been range bound over here. Maybe it created resistance at 50%. If we look at maybe probably the 50% levels, again, it will be giving us a weakness in the market where it started making lower lows, and the end of the day, ultimately it came down to the structure. So rise upward was 80% from this top level. Again, if we see in terms of 80%, it has been falling down. How to look at the structure? Yes, there was a high, then a low, again a lower high, lower low, lower high, lower low, lower high, lower low. And from here again, it started changing the structure. Somewhere around, if the market has fallen down by 80%, yes, probably we can start trailing our stop losses. And if it doesn't go below that, or we probably if it goes above this high over here, yes, we can again start buying for the upward structure. So again, if we see probably in the previous structures or maybe in the next structures, we'll be again finding the same thing, which is starting from this bottom to this high and this reversal. So probably for you, I'll just try to make this across. So the bottom was 24. So high over here comes to around 140 in May 1937. If you look for high, which was there in May 1937, it was, you can see that the main trend swings continued up without even breaking a swing bottom, finally crossing the high of May 1937. If we see in May 1937, we had a high, and this high was somewhere around, so this is 144 minus 4. If we see, this is 140. Probably let's have try to find out a similar kind of structure. I'll probably just draw in front of you. We had a bottom which was 24. So this is 24. We had a high which was 140. So this is 140. So probably you can see this blue mark which are there, 24 and 40, which has been coming over here. We had 24, the market did go up to 140. And from 140, the market did reverse back. This is somewhere around 44 level. This is what I guess, because this is a bottom and again this is a second bottom. So we'll consider this as 44 over here. We'll probably try to mark 25% level, and if we see the 25% level, again coming to 44 levels. So this is somewhere around 44, and if we see the price drop, this is somewhere around 70%. And if we see in terms of ratios, this is somewhere around again from the bottom to the high. From the high, it has somewhere around again dropped by up to 25%, which we had seen over here also at the 25% level. Again at the bottom, if I see down again, it is almost at the same levels. Fine. And this price is coming to almost around 44. So from a bottom of 24 to a high of 144 of 140, the prices again did drop down to somewhere around 44, which is just nearer to the 25% level. So either a 50% level or a 25% level, these two are very important levels which we need to identify, and which you are able to see that yes, again the bottom has been coming down to those levels, and probably this is how the market structure keeps on moving further. So what we see is from the first initial structure, if we know the high, the low, the reversal, probably we can know till what level the market can go down. Again, in a similar way, if we know the bottom, the high, we again are being able to identify where exactly this level has been coming down to. So if we know the ratios and the proportions, probably it becomes much more easier for us to understand the structure of the market, how that has been going. And these are probably like the hidden rules which have been given. And if you are able to identify these hidden rules, maybe the patterns can be identified easily. We can know till what levels we are able to identify the lows, and on the basis of that we can also predict the highs. Just like we saw over here, from this high to this low level and this reversal, we were able to predict this low, and same way from this low to this high level we were then able to predict our bottom, which was been coming exactly at the same level that we saw on this chart. So the charts, again, the levels, the ratios and proportions can be identified accordingly. Let's meet in the next section, and probably we'll get more of into the details as we progress further. Thank you so much. Bye. Take care.